not going to get through this without laughing. Hello, YouTubers. Welcome back again. Only we know what that means. But so Brandon's back finally. We were all busy. You know, we haven't been around, but we're gonna get straight into it. Me and Kaylin, we were talking earlier today about what to present today, and you're gonna present your Amazon trade, was it?
Yeah, it's not really like a trade. It's kind of like a long-term investment. I just want to touch on kind of like why I picked my entries and stuff. Yeah. So like, do you want to touch on your XPeng?
Yeah. So I'm just gonna touch on XPeng first, and then we'll get Brendan, and then we'll just show yours, and we'll get Brendan to talk about the Fed meeting because that one was kind of interesting too. It affected the whole market. But Chem, if you could pull up my screen, let me see if I can get XPeng on the screen here. There we go. This is on the weekly. And like we're just saying earlier, because XPeng was like my second largest holding, and I've been underwater for most of the year. Like, because you could see, like, this was November 20th when it peaked, and it went all the way down to March 22nd. So what was that? That was like a huge, it was like 60-70% drop, 65% drop from the peak. Right. So what my original trade was, I bought this bounce because it was a Fibonacci level, it's a 618 retracement, and I sold here. And I reloaded here thinking that it's going to be a good time to size in. It just kept going down. I think my average buy price at the time was like $47 US, something like that. And it just kept dropping all the way down to $24 US. And even most recent as May, it bottomed like 22 bucks. But I just wanted to show this because what I did was, even though it went lower, I do what I always do with my investments. I look at the fundamentals, and the company was still doing crazy year-over-year sales, and their balance sheet. Like, Brandon, you looked at their balance sheet. You said they were pretty solid, especially compared to Neo, right?
Yeah. So I recall, I think I was looking through free cash flow yields, and I think it was more reasonably priced than some of the other Chinese EV companies.
Yeah, and I think their debt to equity was pretty good too. Like their like their financials are okay. So I was like, okay, well, this sell-off is just all hype and whatnot. So this whole movement here. I was basically dollar cost averaging. And I think what I ended up was, let me just see here. I ended up with $35 average cost US. So I started at 47, somewhere around here. And I ended up buying the dip around here. And I ended up with $45. So then now that's $35. And now it's on the way up. I'm going to start to sell because I've accumulated quite a bit. And I wanted to get some free cash flow. But I wanted to point out something interesting, Kayla, you might hate me for it. During this period here, in its 20s, even I was freaking out because I thought it was going to do a double bottom, and it went down like another 12%. So during this 12% period, I was like, I had like some money on the side as always, but then I'm like, do I really want to throw more money at this? Because I've been dollar cost averaging for like almost 3 months, right? And so what I ended up doing was I bought some out of the money calls. I threw out like, but look, like I threw out like 50 cent, like a couple of 50 cent orders, right? So there's like low ball. I'm like, you know what? I want to participate on the upside if this thing turns it around, but I don't want to throw much money at this thing. So my risk was like $200 USD. My upside potentially unlimited, right?
Right.
And so I caught that dip. I ended up getting a couple of January calls and a couple of and this was it October 2021 call, and this actually sold the other day to hit my sell order. So I bought it for 50 cents. I sold it for like $155. So $1.67 was my sell. So I got back like maybe what was that, like 75% of my principal. And so now these calls here, they're still in the money. It's about 500 USD. I'm just going to let them run because they don't expire till January. So I may unload them, in the fall or something like that. So this was something new that I was trying. I'm like, so, trying to answer the question of, I still have belief in this company, but something's just not right with the market. I want to participate on the upside, but I want to really limit my risk. And I thought this was like a nice compromise to go with the stock options, the calls.
I think the reason it probably came down that hard as well is because, like, we're in such a big retail environment right now. Like, you get a spike like that, you look at that on any stock when you have a big run like that right now, you just get so many people that are chasing the thing up, right? So as soon as it starts to come down, you're just going to have more selling pressure than you usually would.
Yeah, and I think this is what freaked people out too. Like, when it broke that line, I mean, I think people were expecting a bounce here, but then when it broke that line, it just dropped like.
Yeah, that's actually that's one of my favorite, like, kind of short-term long setups though. Actually, if you get a big spike like that, and then when you get kind of like that big waterfall, and you get a smaller bounce, it goes to a new low, but it comes back really quick, that's a great setup to go long, like especially on the shorter time frames, because that, you know, I don't know how, if it has the same principle here, but on the shorter time frames, that traps shorts because they think you're breaking that double bottom. Everybody shorts it, and then as soon as it recovers, you get all the guys that are covering into that. Everybody goes long, and that could be why you had, like, because if you go to the daily chart, I think it was just like straight green for a couple of weeks every single day. Yeah, like look at that. Like those like that pattern right there is like death to shorts because there's no dip.
What kind of momentum oscillator are you using? Are you using relative strength? Are you using?
Yeah, my bread and butter is just RSI, and I don't look at moving averages, just chart patterns and RSI.
So I have a Williams oscillator on my screen here, and this it's absolutely breathtaking. On the weekly chart, we're at all-time highs of momentum, which is funny because we're not even near all-time high price.
Yeah,
that's bullish divergence right there. So this actually looks pretty good. I like the increasing low volume as well.
Yep.
And it's funny because I would have thought that like $41 would have been a natural point of resistance, but we just blew past that last week. We retested that like $39 level and rejected it. So yeah, this thing looks good.
Yeah, so it had some trouble here at breaking 41 and had that one hiccup, but then it just kept going. Still made higher lows and higher highs. So then, you know, it's a hiccup, but it made it.
Yeah,
so I think a lot of this has to do, guys, with what we've been talking about for such a long time on this podcast. Is we're experiencing a changing of the guard, or we're seeing a rotation from value to growth. Value was the market darling for the first half of 2021. I think the second half of 2021 will be defined by growth stocks and growth stocks resuming leadership. So I think like this, though I don't know it very well, and I definitely need to do some more research. I want to be in more high growth names, especially if you see if bond yields tick down. Like the 10-year yield closed at about 144. That's going to be very good for those stocks.
And Kaylin, so you said you wanted to say something about the chart earlier?
Yeah, I was just saying it's crazy like how many resistance lines it just kind of like walked through with no problem.
Yeah, you know what I feel like happened? Because this was the original rally that everybody thought was going to happen. And I think there was a huge sell-off here, and I can't remember what caused it, March 21st. I think that was a bond thing also. But what I think happened was this chewed up all the extra demand, extra supply. So this chewed up extra supply, and then this was just fear selling. And then by the time we got to this point, there's just no more sell pressure. Like all the sell pressure that should have been in this area was taken care of by this original rally.
Yeah, like it's just really steady in both directions. It's kind of funky.
Yeah, and the media has a lot to do with it because during this period has been nonstop like glowing news. I don't know who they're paying off because it's just been pure glowing news about them. It's like you know, they're increasing sales quarter over quarter. They beat one big thing though, they finally beat NEO in terms of growth or sales actually. So for the month of May, they sold more units than NEO. And so like this has always been my premise about these guys over NEO. First of all, I don't like NEO's charging idea with the battery swap. But aside from that, NEO is almost twice the market cap of XPeng, and yet they're only about maybe 20% more in sales. And so like where's the value, right?
Yeah,
XPeng is much better financially because they're holding a lot less debt, and I think, Brandon, you looked at this before when you were looking at the charts. XPeng was increasing sales at a faster rate than NEO was.
So XPeng year 2021 is growing revenue 146%, 87% next year, and in 2023, 54%. They're still going to be making losses for the next, it looks like 4 years if I trust these estimates. But you're right, very, very little debt. Maybe only like, you know, less than like 10% of the market cap.
Yeah. So as you know, the people who want to be value investors, like there's value in growth stocks too. It just depends on how you define value, right? And so what you were saying earlier, if you're right, like if we all believe that the rotation into value is stupid and that growth is going to be the big winner at the end of the year. This is one of those picks.
Well, what I've noticed about this secular bull market, this bull run that we've had over the last, let's say, 12 years, is that we do have these little spurts where value does outperform growth, but it only lasts about 7 to 9 months, in my estimation. It's like a counter trend rally. And we saw that happen last year when the NASDAQ had like a 3 to 4 month consolidation. We're having the same thing now. Had it in 2016, had it again, I want to say in like 2011. So these cycles do happen, but the longer periods of growth is for growth stocks, and the counter trend is for value.
Yeah, that makes
So
sense.
when you do get these consolidations for growth, you take your money and you buy your favorite stocks, your favorite growth stocks on weakness. That's always the game plan.
So speaking of that, let me see if I can pull it up. Kalen, you got into a long position with Amazon, right?
Yeah, I did. So pull up the Nvidia chart first, real quick, if you don't mind. Just on just on the daily.
Never mind pulling up Nvidia. This is our call.
Yeah. So zoom right out on that a little bit, just so you can see a bit more, or zoom right in.
Oh yeah, like the daily.
Yeah. Zoom out so I can see. Are you on the daily?
Yeah.
That is a daily. That's that massive shooting star wick from Friday.
Yeah, so just zoom like way out so you can see like
zoom out. Sorry, I don't
That's
my
you zoomed right into like one bar.
Yeah.
So I bought this one for a long-term investment, right? So like I kind of loaded up like around the low 500s, and now obviously we just had a pretty solid run like straight up to 700. So if you go out like maybe if you go to the weekly or something like that, I just want to show like kind of the overall trend on this thing, just to get a better idea, and just kind of the way it relates to Amazon. So yeah, so you can see there, like, see how we kind of had that big run up like all last year, and now we've kind of just gone like straight sideways, and then we get this big push up again, right? So it's kind of like that old sort of stair-stepping pattern that we see in some of these big stocks. So with that said, if you want to pop over to Amazon, because I've been waiting to get into Amazon for a while because I just want to own it. But I was kind of looking at like a decent spot to get into it. So if you look at that chart, and like again, if you kind of zoom out even further, we're kind of in a similar sort of thing. Like we went up, and then it kind of goes like it just sort of starting to go across in that stair stepping pattern. Yeah, you can see it there. Again, sort of through that point there, and then you get like these nice big runs up, and then we had another thing, just in this past year, we've kind of consolidated for a while, and now like with the way it's looking here, I'm expecting basically just like a nice clean run straight up. So I jumped in, I think it was around $3,300 a share, and I think what are we now, like 35 or 36 or something like that?
34.
Where are we at now?
34.86.
Yeah.
34. Yeah, so I got in at 33.
Well, if you measure the point of consolidation and you measure the last breakout out, and then you take that and add it to the consolidation right now, which we often do in technical analysis, that would take the Amazon price to about 4,500.
Yeah.
And I agree with you. Amazon gains are often very long. You'll have a period of like a year and a half where the share price just does nothing, and then we'll break out on a high volume, we'll run for 6 months, a year and a half. We don't know how long, but there's never been a wrong time to buy it.
Yeah, that was kind of my theory. I just like I said, I mean, I always wanted to own it, and I was just kind of looking at the two of them. I already got into Nvidia, and then I was kind of looking back and forth. I was looking at Amazon, looking at Apple, just kind of like building my portfolio a bit. And I looked at Amazon, I just saw that correlation, and it looked like it's right around where Nvidia was like about a month ago, before it started that big run. So I figured, now is probably as good a time as any to get in, and that's kind of what I'm expecting, is it to at least go up over $4,000 a share. So like I said, it's a long-term investment for me. It's just that was my thought process in getting into it. It's not a swing trade. Like, it's something I'll hold for a long time. So
yeah, it's a long-term hold. You'll never have to sell Amazon. And the same thing is going to happen with Apple too. It's forming that same consolidation pattern. It's been consolidating since they announced the new iPhone in like September. And it's just biding its time before that big breakout. And these things are super cyclical. Like we had a breakout on Nvidia about a few weeks ago. We had the breakout on Facebook about a month ago, a breakout on Alphabet before that. We have Amazon coming up. Apple's going to be next. So it's just rotating. But these FANG stocks, you want to stay long these FANG stocks. It doesn't matter which ones you're in. Some of them are going to be leading back at different times, but you want to be in all of them. And the way that I look at FANG, replace the N in FANG, take out Netflix and put Nvidia in. It has double the market cap, and it truly is one of the market leaders.
Yeah. Like all these charts, like you said, Apple, Amazon, Nvidia, they all look the same. Like they almost look identical. And you look at Nvidia, that huge run it's having right now. Amazon and Apple are just right behind that. So I've just been loading into both of those right now just to build my portfolio. So I'm expecting to kind of, get that nice, really big push up, just get ahead of it, and then just kind of sit on it.
What did you superimpose on it? Nvidia?
I'm sorry?
What did you superimpose on it? Amazon or Nvidia?
I think this is superimposed Amazon. So looks like Amazon's had a harder road up, where Apple's more consistent. They're almost inverted, almost.
Well, one just looks like it has a greater slope. They're both going up, parallel channels, right?
Yeah.
Yeah,
they're both kind of setting that similar sort of pattern that we're in right now.
You know what? The charts really tell a story. If you look at Apple, they're kind of over doing this arc, and it looks like they're starting to lose momentum. And it started, I think, Steve was gone, right? And Tim Cook's beautiful management has kept them going. Whereas Amazon, you can just see an exponential growth of adoption and acceptance.
Well, I don't know if I look at it that way. Apple has almost like a $2.5 trillion market cap. Like it's going to take so much more to move a company that has a $2.5 billion market cap than a company like Amazon, whatever it was back in 2013.
Yeah,
that's fair.
Amazon looks like
games to give you 10 times return in a year, right? It's just not going to happen. But something like an Nvidia that's trading at $400 billion market cap, I see room for a ton of upside, considering the amount of end markets that they're in.
I'm just curious what Nvidia is like compared to Apple. There seems to be like the standard.
The slope is going to be. Yeah.
What the fuck? Hey, what was the hot word 3 months ago? Bubble?
Speaking of bubble, I gotta bring this up.
Wait. Before you say that, I will say there is no bubble in Nvidia here, man.
That's the irony.
If anything, is one of the most underpriced stocks that I've ever seen. The amount of end markets that this company in is just phenomenal. They're leading the way with self-driving cars. They own the GPU, the gaming market. They control VR. They control AI for healthcare. Like the company, especially if they end up taking over ARM, which is a story that we can get into later on if you guys want. It's not only establishing itself as like a tech leader, as a total world juggernaut in multiple different industries.
Yeah, it's insane.
It's insane.
I love it.
I think Nvidia is just a $1 billion market cap just waiting to happen. It's still just a beginning. There's no stock in the whole realm that excites me.
48,000% since 2015.
Wow.
Does that even make sense? I don't know. There's no way.
From the lows. Oh, you know what? I missed the low. Let's say, where's 2015?
No
2015 was
it was $30 in 2015. So you can't even say that.
It says 11 cents. Did they split?
No, you're looking at.
They've done one split. I can't remember what it was though.
No, they have not done a split since a very, very long time. They have not done a split.
I know they've only done one. The whole company.
$30 in 2015.
Yeah, it says 28.91 from where I'm starting. Maybe the chart's funky.
It says what?
28.91 from where I'm starting. So you're right, but I don't know why the percentage is funky.
Yeah, there's no way. I mean, it's a great performer. I wish it was 40,000% because I've been Nvidia since that time.
All right, let's do this the proper way. I'm gonna check it out on the real chart. The low of 2015. Here we go. 6,600% ish.
Oh, it's not too bad.
Not too bad at all. In what, the 5 years, 6 years since? Like that's
Unreal.
It's just the people who trade like the SPACs and the meme stocks. Like, dude, this is what quality can do. Like, fuck.
Okay, so on the meme stocks, I just got to read this post I saw on Bloomberg. So it says Michael Burry warns retail traders about, in quotes, the mother of all crashes. He says he's warning retail investors for losses the size of countries that are on the horizon if crypto and meme stocks decline. What are you guys' thoughts on that?
I think he's an idiot, Brandon.
Well, yeah, but
Well, I just don't understand what the purpose of him putting out this tweet or this article out. Like, is he trying to scare retail investors out of stocks and trying to ignore, the number one way to increase your wealth and investing? Like,
yeah,
a long time, right? Maybe he has billions of dollars to afford to switch his opinion every day, whether to short Tesla or go into Bitcoin or buy something speculative. But at the end of the day, when you're talking about your average investor, they don't have the luxury that a guy like Michael Burry has.
Yeah. You know what I think is, I think he's like, for retail investors, I think he's like this, like, he's like the guy. I don't know why, like, because he's got the movie The Big Short.
I thought Elon Musk was the guy.
Sorry?
I thought Elon Musk was the guy, or like that other guy, Mark.
No, I feel like because of that movie, man, The Big Short, I see so many people talking about that are all these like new retail investors. They're just obsessed with this movie. So I feel like everybody thinks he's like the gospel when it comes to like these big monster crashes and these big shorts, because he had 2008, he had the one bet, right?
Well, nobody's gospel. No one has a crystal ball. No one can predict the future. Not even the Fed, not even Jerome Powell. Like, we're all just taking this as it goes, and we're using our best judgment and we're doing our research. But to say that something's going to happen, I mean, I think that's so unfounded, given inflation is still low by all of my metrics. The economy is improving. Earnings are going up. We have really sound financial regulations. Like, this isn't like 2006, 2008 here. And we've been consolidating for the past, 6 months on NASDAQ. Meanwhile, earnings went up, prices went down, or the PE range went lower. This market looks fantastic. There's no reason not to invest in the market. What else are you going to invest in? Bonds don't give you anything. Gold. You guys saw gold on Thursday. Friday. It absolutely plummeted. It started to get 700. Like, where else are you going to put your money besides stock?
Yeah. Yeah, I think he's just talking about like just all the hype that's all around this stuff now, because like, we've talked about it a million times how easy it is to invest, and anybody who's new, who's got $1,000, they just want to throw it all into the next big 10,000% gainer and win the lottery and all this stuff. And like, I'm talking to a couple of my other buddies about this too. It's just like, it's one of those things where I think you're gonna have like David, that video you sent me, what was the guy in that interview you sent me over WhatsApp the other day?
Well, so which video was this? Sorry.
The one, it was like a half-hour video interview, the guy that like he traded through the .com bubble, like all that kind of stuff. But he's talking about, I guess in the .com bubble, like Japan was apparently like a huge proponent of that, from what he was saying. And he basically said that like that whole retail aspect still hasn't fully gotten back into the markets after like 20 years. So I think
the Stan Druckenmiller video?
Yeah, that was it. Yeah, so that's what he was talking about. So that's kind of what I'm thinking here, is you're going to have like this massive generation of people who, I think you're going to have like, well, probably like 3 scenarios the way I see it. You're going to have people who make a ton of money, like in their first year trading, like tons and tons of money. And then those people are going to take it out. They're going to, put it into real companies. They're going to count it as a win, buy real estate, whatever they're going to do, and they'll be fine. And then you're going to have this other group of people who are just going to ride stuff up and then ride it back down. They're going to lose all their money. It's going to be emotionally destroying. So
and they're going from hype bubble to hype bubble. They're going, they're playing cannabis, they're playing emerging markets, they're playing like weird fucking commodities. They're going to crypto, they're going to crypto again, NFTs, Beanie Babies, like.
So you're gonna have those people, and they're just gonna ride stuff up and then back down to zero. So you're gonna look at your account and say, oh, I'm up $100,000, and then you're gonna ride it all the way back down. You're gonna end up taking a loss or something, and that's just gonna screw with you mentally. You'll never be able to look at a trade the same way again. And then you're gonna have the other people who ride stuff up, sell it, make a whole crap ton of money, and then they're just gonna just throw it all into the next big thing, throw it all into the next big thing. And then they're going to end up losing everything, and they'll just never be able to come back from that. So I think there's going to be one scenario where you have like a pretty small group of intelligent people who count it as a win, take the money and run, put it into something good, and then you're going to have like probably 95% of the rest of them that are just going to be absolutely traumatized by the markets, and you're going to have this huge generation of people who are just going to think that the markets are gambling, and it's scary, and you can lose all your money, and and then you're going to have this giant cluster of people who are just going to hate the markets and not want anything to do with it. And, I think that's what that video, David, you sent me, that was kind of what he was saying about the dot-com bubble in the 90s. I guess Japan was the biggest retail traders back then. And he says that market in Japan, that retail market still isn't even close to how big it was back then, because they were all just so like traumatized by those losses and by those, those wins and like just that fluctuation they were dealing.
I think we should definitely pop up the Nikkei in the 80s. But before we do that, I just want to ask you guys, what about the group of people that just invest in quality stocks, in indices, just have a very like even keel approach? They just invest in quality companies. They dollar cost average. They slowly see their portfolios go up about 10% a year with dividends, and see the compound, like maybe in the first 10 years it only doubled, but in the next 4 years it doubles again, and then like it just snowballs.
Yeah, but that's perfect, right? That's what I mean. Like you're gonna have that's gonna be that really small group of people that do make a lot of money.
Our generation, it's gonna be super small because people these days, they all know instant gratification. They want to feel that sugar high where they, they're day trading and they're making all this money, and they have like delusions of grandeur, and they have these crazy dreams of like buying a Lambo or whatever, everyone's thinking of these days. People that have a really sound investment approach and that don't let their investments and their emotions rather get the best of them. It's a rarity.
Yeah, that's the biggest thing, right? But you have so many new people. I think, like David, you and I don't know about you, Brandon, I don't know if you've ever actually like traded short term or not before, but like, I know when I first got into the markets, I was kind of of the same mentality. I was like, oh, I'm just going to make a whole ton of money. This is going to be great. Like, all these low float stocks are moving like crazy. And then, I've always been smart with my money though. Like I've never, like when I first started trading, I think the biggest loss I had was like $280. So like I never bet huge because I knew I didn't know what I was doing still. But I still was like, oh, okay, I could make $1,000 every day if I do this. Like I'll be doing that no problem, like, next week kind of thing. So like a lot of people have that delusion, but like there's those people who just empty their savings and take out a mortgage and just bet so big on these stocks. And those, like, I think, more people are like that than are like me from what I see on the internet anyways, which is, that's going to be the problem right there.
Absolutely.
All right, guys, we're going to wrap it up here. It's been a rough day with technical difficulties, but hopefully you still got something out of this video, and we'll be back next week. Thanks for tuning in. Remember to subscribe, like our videos, give us some comments, and see you later.